Hello, everybody. This is John Ryan of Ryan Insurance Strategy Consultants, and I want to thank you for coming to today's webinar. You're in for a real treat. Veralytic Research is a platform that I was introduced to several years ago by Barry Flagg. It's a great tool for advisors to be able to reasonably predict the future of their clients' permanent life insurance policy performance. I know this is really, I've seen Barry speak 3 or 4 times already, and I can never get enough of what he has to say. The webinar is going to be CE eligible, so at the conclusion of the presentation, you'll be getting an email from Ryan Insurance Strategy Consultants that is going to give you, ask you what we need in order to file for your CFP CE, your 1-hour credit. Also going to give you information on how to access the recording and the slides. So be on the lookout for that following the presentation. I also have, I'm required to use a couple of passwords here to make sure that those that, well, just to make sure that people are listening. So in a few minutes, I'm going to give a 1 of 2 passwords that you will just write down. And when you get the email from us requesting the information we need to file for your CE, you'll be inputting the first password and the second one. So, you know, Barry does a really good job at introducing himself throughout the presentation because he's an investment guy originally. His dad was a pension actuary and had a financial planning practice that specialized in pension planning. And Barry kind of worked in his office. And Barry was originally put in charge of doing due diligence on certain investments that clients were considering. And, you know, there were tools like Morningstar and other kinds of tools that were readily available to help advisors evaluate the potential future performance of an investment based on past performance. And later on in his career, Barry was asked to start to do that with life insurance, to evaluate permanent life insurance. And what he found was that there just were not the tools available in the insurance industry to evaluate insurance products that there were in the investment world. So Barry set out in 2001 or 2002, I can't recall, to patent Veralytic. And there's a lot of similarities between Veralytic and like a Morningstar report, for instance. But for the first time, we're able to look at policy illustrations and look at the projected values and determine how reliable they might be based on actual historical performance and not just the flavor of the day pricing in order to attract policyholders and then raise the premiums later on. So if you have questions, ask them. Barry's agreed to answer questions as we go, and so use the question box for that. And before I introduce Barry, I'm going to give you the first password, and the first password is Veralytic. So without any further ado, Barry, it's all yours.
Thanks, John. Good to be doing this with you again. John mentioned my dad was in the financial planning business. He actually started in the life insurance business, and like many that I address in webinars like this or at conferences, my dad got frustrated by the life insurance business. He was an engineer by training, became a fiduciary. You know, he's was an analytical guy, and I find that those same characteristics in a lot of the people that I talk to, again, at webinars or conferences, and probably a lot of people on this call. About half the people that I come across started in the life insurance business, didn't like the opacity of it, didn't like the fact that it was hard to get a straight answer, and they migrated to the investment business because there you could find out what costs were, and you could find out what historical performance was, and there were tools like Morningstar. as John mentioned, I started my career in the pension investment advisory business using Morningstar. The partners in the firm would come back from meetings with clients, pension and profit sharing plan statements, come back from the meetings with pension and profit sharing plan statements and give them to me. My job was to look the funds in the plan up in Morningstar, and then summarize, prepare a summary for the partner to go back to the client and say, here are the funds where you're being charged fairly. Here are the funds where you're not being charged correctly or you're being overcharged. Here are the funds with good performance. Here are the funds with bad performance. And then the report included all the Morningstar reports as backup. And they'd go out and advise clients on their duties as a fiduciary to a qualified plan, talking to them about the liability, but then also talking to them about, hey, you're the biggest participant, your account balance is the biggest in the plan, so you're going to be the biggest benefactor from going through this prudent process of lowering costs and improving performance. And as John also mentioned, you fast forward some years and I sought to diversify my career, my experience, and broaden my resume. And I went to go work for a life insurance agency. And for those who know me or have seen me, you know that I'm only half joking, and John can attest, I'm only half joking when I say I pulled my hair out trying to do what was easy in the investment business with Morningstar, and it was literally impossible in the insurance business. And I say literally impossible because the United States Patent Office determined it was literally impossible and awarded us the first of our patents. Actually, John, you were right on the number, in 2002. And we've been publishing pricing and performance research for life insurance products in the same way Morningstar publishes pricing and performance research and ratings, in both cases, and ratings for mutual funds. So what I hope to accomplish today is that for those of you who maybe spent some time in the insurance business and found it distasteful or uncomfortable, and for those of you who may be in the life insurance business but are interested in doing things in a more client's best interest or fiduciary manner, given the entire industry's movement in that direction, I hope to give you a bit of a framework for how you can think about life insurance, for how you can think about managing life insurance as an asset, how you can think about the prudent selection of a product or retention of a product, and how to manage a product, and how Veralytic is very useful in that regard, in the same way that I couldn't have done my job as a pension investment advisory analyst without Morningstar. So with that, I'll kick it off, unless, John, you have anything else to chime in with?
No, Barry, nope, just keep going.
Okay. So I'm hoping technology is working and that a situation slide has come up from the title screen. John? As the slide changes? Okay.
Yes, sir. You're all set.
Okay. So, I was having been born into a financial planning family. I early on kind of had my direction and ended up being the youngest CFP in the history of the College of Financial Planning. An entire segment of the CFP curriculum is devoted to risk management. And life insurance is a big part of that in personal financial planning. And so I'm thinking, life insurance should be something that is, particularly for anybody who does tax planning, life insurance should be something that is talked about more often than it actually is. Because there are 4 tax preferences, which I won't go over here because this group almost certainly knows them well. Life insurance enjoys 4 tax preferences that are unique to life insurance. They are not found anywhere else. And so if you're doing any kind of tax planning, any type of estate planning, retirement planning, supplemental retirement planning, or traditional risk management for buy-sell, for key man for family income replacement. I mean, life insurance is the only thing that can do what it does, and yet I experienced great resistance to certain professionals, great resistance to life insurance among certain planning professionals, certain financial professionals. And with some experience, it became clear to me that the discomfort and the resistance was that involved the opacity of the product, the inability to find out what's actually going on inside the product, and that every time you got an updated illustration, it seemed to be different, and there was no rhyme or reason, or things just didn't come true. I would argue, in fact, that life insurance is the last largest, most neglected, and worst performing asset relative to clients' expectations over the last 40 years. So even though it has all these tax preferences, it's hard to embrace a financial vehicle that has underperformed client expectations for decades and decades in a row. And it's underperformed because very few know what's actually being charged. Very few know that the costs vary by as much as 80%. It is a common misunderstanding that, it's a life insurance. How much difference can there be between life insurance product A and life insurance product B? There just really isn't that much different, when in fact there are huge differences on the internal costs, which we'll talk about. Few know what they're actually getting in performance. And if you think about any asset on the client's balance sheet, if the client or the advisors don't know what's actually being charged and don't know what they're actually getting in performance, no wonder why it's among the worst performing asset types relative to client expectations. And no wonder why clients and advisors alike are resistant to talking about this thing that they can't get their head around. What I hope to do today, one of the tools that I want to give you, that I hope to help you get your head around life insurance in an entirely new way, is a different way to think about life insurance. Life insurance is too often understood, or it's tried to be understood. Not very good English, but people try to understand life insurance from these hypothetical illustrations that are different every year. There are hundreds and hundreds of numbers, dozens and dozens of pages, and the numbers change every year. And it's just impossible to understand life insurance, how life insurance works from those illustrations. Instead, I would encourage you to embrace the same information and insist on getting the same information for life insurance that you get for every other asset on the client's balance sheets. Ask the broker or the insurer, what are you going to charge me for cost of insurance charges? What are you going to charge me for policy expenses? And get a representation from the insurer or from the broker as to what they think is reasonable to expect on the earnings on cash values and premiums, and why. So instead of the illustrations, I would encourage you to write down this formula as an easy way to remember that you want cost of insurance charges, you want the expenses, and you want justification for what the interest rate is that's assumed in the policy. This information is commonly available. It's not necessarily commonly provided, but it is commonly available. If you ask for this information, 99% of the time you will get it for universal life products. It's not available for whole life products. So what you need to ask for whole life products is just the dividend interest crediting rate. But this information is readily available from 99% of the insurers out there, and it is essential to get these three distinct elements for a variety of reasons we'll talk about today, one of which is Bob Veras, who I suspect many on this call know. Bob Veras wrote an article called Fiduciary Life. If you are not a subscriber, Bob has given me permission to share this. But he in that article, he talks about a little bit about my background and how I had discovered early on that, as John discovered early on, it was next to impossible to do with insurance, to analyze insurance the way I was able to analyze investments without getting this type of information. And if you don't get that, the information that goes with that formula, if you don't get COIs and expenses and interest, read Bob's article, and he will talk about how you will be astounded about what you find in some of these illustrations. When you get an illustration from an insurer or from a broker, and the interest rate at the top may say 5% or 6%, you will be amazed at what you see in the detailed expense pages. Too much to go into here, but I encourage you to read Bob's article and make sure you get, anytime you're talking about life insurance with a client, make sure you get what are generically called the detailed expense pages, but different insurance companies call them different things. I don't know why I'm doing this again. So the insurance industry has tried to address these problems with these illustrations. And I'm going to spend just a minute on this to make the point that using the illustrations are just not useful. They weren't useful to me. As Bob pointed out, they're really not useful. Bob pointed out in his article, they're really not useful. The insurance industry tried to make them useful in 1993. So 25 years ago, they issued model regulations to ensure that illustrations do not mislead purchasers and make insurance illustrations more understandable. And John can verify this. I ask for a show of hands. Every time I do this in front of a live audience, I ask for a show of hands of those people who think that over the last 25 years, insurance illustrations have become more understandable and less misleading, and not a single hand goes up. Instead, by their own admission, the National Association of Insurance Commissioners had to update the rules in 2015 to make illustrations that appeared to use the same crediting rate, kind of like what Bob talks about in his article. They appeared to use the same interest rate, and yet they used different interest rates. So if you're trying to compare a illustration of hypothetical policy values, and one of them they both appear to be using the same interest rate, but one is actually using a different interest rate. It's like comparing two investments at different hypothetical rates of return. One's going to look better without actually being better. So instead, did you want to comment, John?
Well, yeah, I just want to say, first of all, I agreed with that statement, and I just have a couple of questions here. Someone wanted to know if we have permission to forward that article from Bob Veras. I don't know if we do have that permission, but wasn't that December 2017, I think, that article?
I believe so.
Yeah, and then there's a question, can Ryan help us evaluate our clients' permanent life insurance policies? And of course, the answer is yes. And some of you got in just after I gave the first code, the first of two passwords. The first of the two passwords is Veralytic. I'll be giving the second one towards the end. Okay, go ahead, Barry.
So Bob did send me a copy and said that I could share it. Now, I don't know that I have as big a following as you, John. So I don't know if Bob wants me to share it with all your followers. But kidding aside, I will check with Bob, and there's going to be a link at the end where you can download the presentation, the handouts, and/or I can send it to you. And one way or another, I'm confident, but I will confirm that we can get copies of Bob's article to anybody who wants it.
Okay. Yeah. Great.
So if the insurance industry has struggled for 25 years to try to make illustrations less misleading, if the insurance industry has struggled for 25 years and continues to struggle, as Bob points out, to make illustrations less misleading and more understandable, the alternative to me, having come from the fiduciary environment, was really simple. That comparing one piece of paper that's never going to come true to another piece of paper that's never going to come true never made any sense to me. coming from the fiduciary environment first, it was very clear to me what the information that's essential to prudent decision making, and that is all outlined in the Prudent Investor Act, which I know more than most everybody on this call already knows, but I'm just going to reference it quickly and then tie it to life insurance. So one, the Prudent Investor Act says that advisors exercise reasonable care, skill, and caution in the performance of their duties, in giving advice, and relying on pieces of paper that never come true is probably not meet that standard. The Prudent Investor Act talks about the Financial Industry Regulatory Authority, which some on the call may not be subject to, but in terms of guidance, has a rule regarding variable life insurance illustrations, and the rule says it is inappropriate to compare a life insurance policy life insurance illustration one to another because it's misleading unless you're talking about the very things that we talked about earlier, the cost of insurance charges and the expenses. Even the Society of Actuaries years ago published a study saying that comparing illustrations to determine which product is better, is not just inappropriate, but fundamentally inappropriate. And the most recent example of parallel authority is the OCC updated their handbook for unique and hard to value assets, added a chapter for life insurance, and in that chapter they talk about how these policy illustrations are subject to a high degree of fluctuation, and anything that's subject to a high degree of fluctuation is certainly not reliable for making determinations. So the title of this talk is How to Protect Clients from Unscrupulous Life Insurance Industry Practices. This prevailing practice of comparing hypothetical premiums to hypothetical cash values and hypothetical death benefits, it is dangerous to the fiduciaries and certainly for trustees of life insurance trusts who have a duty to exercise reasonable care, skill, and caution. Comparing something that's misleading, fundamentally inappropriate, unreliable is a breach of that duty. People who are not necessarily trustees, but also fiduciaries, I would argue that there is an element of danger there. And there's a danger to the client that they're going to continue to experience disappointing performance because I think that this misuse of illustrations is at the center of a lot of the underperformance that we've experienced in life insurance products. So instead, looking at the prudent process that I grew up in, so we talked about the new performance formula for life insurance. It's based on the same prudent investor principles outlined in the Prudent Investor Act, that a fiduciary advises clients or ensures that clients incur only those costs that are reasonable and appropriate. That doesn't mean that it's the lowest cost. It just means that we're going to look at costs and we're going to make sure that whatever is charged is reasonable and appropriate. And again, those of you who follow my suggestion and get these detailed expense pages, you will be, and Bob touches on this in the article, you will be astounded at what you find. You will get an illustration where the premium appears to be lower than another product, and yet the costs are higher, with premiums supposedly calculated at the same rate of return. And that's just mathematically impossible. If the costs are higher and the rate of return is the same, the premiums have to be higher, not lower. So for those of you who get these detailed expense pages, I think you will be, I am certain you will be astounded at what you find. So look at the costs, look at the rate of return, look in those detailed expense pages, look at what's being charged look at what's being credited or is assumed to be credited. And again, so some of these illustrations, they prominently display that these hypothetical values are calculated at 5%, and yet you look at the interest credited column and there is much higher than 5% being shown in the illustration. I don't know how they can do it. It just goes back to that National Association of Insurance Commissioners regulation that for 25 years they've been trying to regulate this, and for 25 years, by their own admission, they've been unable to regulate it, and so it's still not these hypothetical values are still not being calculated as you would expect. And so once you have the information as to costs and the information as to performance, then and only then can you exercise reasonable care, skill, and caution in the prudent selection or retention and proper management of life insurance. For most of the years that I was in the insurance business, before Veralytic was founded, there was very little litigation in the life insurance business. John, is that your experience too? John? He may have muted himself.
No, yeah, I did.
Sorry.
No, I haven't. I have not seen it. I know it's coming though. Yeah,
well, I mean, it is since 2000, the early 2000s. It has been on the rise. I've written an article for Trust and Estates magazine that I think is a really, at the risk of breaking my arm, pat myself on the back, a really well outlined difference of the way the life insurance industry works versus the way the fiduciary industry works. In fact, I call it an operating system. It's I think a very good comparison, an illuminating comparison of the life insurance, the results that come out of the life insurance industry operating system, and the results that come out of the fiduciary or the prudent investor industry operating system. And if we have time at the end, and there's interest, we can go down. We can delve into the Cochran case, because I think it is just it's a poster child case. Beyond that, there have been a number of cases since the 2000s that have all centered around, in one way or another, the use or misuse of these illustrations. I think one of the most notable of which is the former CEO of Quest, I believe, sued Goldman Sachs, who you'd think would have, or actually a subsidiary of Goldman Sachs, who you'd think would have some pretty smart people there and would kind of know what they were doing. He sued Goldman Sachs and won. He was a client of Goldman Sachs. It's a really interesting case because the financial advisor actually testified against him in the SEC violation that put him in jail. So he was not happy with Goldman Sachs, and he used this difference between the life insurance industry operating system and the prudent investor industry operating system. He exploited that when his real grievance was against the financial advisor who helped put him in jail. But he was able to use this difference between the life insurance industry operating system that really doesn't support advice and the prudent investor industry operating system, and he used that to be awarded $14 million in a lawsuit against Goldman Sachs. And again, we can talk more about that if we have time at the end. So as an alternative to the life insurance industry operating system, the Financial Planning Association formed a task force in 2011 to help their members advise on life insurance. They had partnered with FI 360. Some of you may be AIFs on the call. The Financial Planning Association had partnered with FI 360 for support on decision making around most investment assets on a client's balance sheet, but there was no guidance for FPA members for providing advice on life insurance products. So they took an established framework originally created by a guy by the name of Don Trone. Many of you may know Don Trone, They took his established framework, formed a task force. I was honored to be one of the first 4 to take the framework and apply it to life insurance, and it was eventually expanded to include 17 individuals from most every profession who has clients who have life insurance. And after 3 days of vetting and arguing and debating with people who have competing interests, from the fiduciary to the lawyer to the administrator to the salesperson, we hammered out using the same decision-making framework that's widely accepted in the investment business. We hammered it out for life insurance. John, did you have something to interject?
Not yet.
Okay. And I don't have enough time to go into there's 6 steps, same 6 steps that are common in the FPA financial planning process. It's 5 steps in some other places, but same 5, 6 steps as everywhere else. 17 dimensions, which are unique to life insurance. I don't have time to go into all of them, but I'm going to hit on a couple of the high points in each of the steps. First of which is in defining the roles of the advisors, in talking about the roles of the advisors, there are conflicts of interest everywhere, and everybody's got them. And it harkens back to my days in the mid-1980s in the investment business, when there were conflicts, many, many more conflicts in the investment business than there are today. We didn't have these open architecture platforms, investment platforms, in the 1980s like we have today. So there were constraints on the ability to get product. There were differences in compensation, much more differences in compensation. So the life insurance business of today looks a lot like the investment business of the 1980s. And so there's no simple answer. The no load is not a universal answer. The proprietary products are not an automatic answer. There are just conflicts that have to be discussed and reconciled, and we'll talk a little bit more about that.
Hey, and Barry, I do have a question that just came in. Is the insurance company required to provide you with detailed costs for in-force illustrations if requested?
I don't know that there's a reg that requires it. It kind of required in caps, but I have never had an insurance company refuse. I've had to ask insurance companies sometimes 2, 3, 4 times because some of them don't even know what it is. But the detailed expense pages are is the math behind the calculation of cash values. So you can't calculate cash values unless you actually have these pages. And I've never, I shouldn't say never. You will occasionally not be able to get them if it's a universal life product from an insurance company, a universal life product that's been discontinued from an insurance company who's no longer in the life insurance business, and they're generating in-force illustrations on a mainframe that hasn't been updated in 20 years. You won't be able to get them in that case. But 99% of the time, you might have to ask once or twice or 3 times, but you'll get them.
And you would be asking for an in-force illustration to include the detailed policy expense page.
Yes.
That's what you would ask for. But also, Barry, it's also true.
And even a new business proposal. Is that what you were just going to say? Yeah. Yep. Even a new business proposal. Absolutely.
Yep. And, so go ahead. We're good.
Okay. All right.
Don't forget to ask your questions, everybody. If you have questions, go ahead and ask them. Please
do. We'll handle them on the fly if they kind of fit, and we'll catch any at the end that we miss. So we start with defining roles, responsibilities, relationships, and conflicts. Then, in my experience, having started in the fiduciary business first, having been a financial CFP at a very young age, it was automatic to me that we start with goals and objectives. And then when I got in the insurance business, it was like, well, we got this great product. We got to go sell it. That universal life was better than whole life in the in the 1980s when interest rates were high. Then variable life was better than universal life in the 1990s when the markets were go-go. And then guaranteed universal life was better than variable life in the 2000s when after the market crashed and people were afraid of market performance. And now indexed universal life, and lo and behold, it's come full circle. Now whole life is among the top sellers. So those people who, and in the Cochrane case, they actually did almost this. So you start with a whole life policy, and under the life insurance industry operating system, the universal life illustration would look better, so you do an exchange from whole life to universal life. And then some years later, the universal life illustration wouldn't look so good, and so the variable life illustration would look good, so you'd do an exchange to variable life. And then some years later, the variable life illustration doesn't look so good, and so you do an exchange to guaranteed universal life because you want some guarantees after all this bad performance. And then you find out the guarantees aren't really guaranteed anymore, and so then you go back to whole life. And Mr. Cochrane would have been far better off had he just stayed with this whole life policy from the very beginning, which, if you start with client goals and objectives, and if whole life was the right thing, he would have stuck with it the whole way. So it's just important to, from a fiduciary perspective, to be wary. Again, the theme here is protect clients from unscrupulous life insurance industry practices. Be wary of the flavor of the day, the tendency to favor flavor of the day products instead of starting with clients' goals and objectives. And once we've defined clients and goals and objectives, and we're resisting flavor of the day, we need to then pick what product makes the most sense. Well, the product that makes the most sense is determined in the same way that the type of product that makes the most sense is determined in the same way that the type of mutual fund would be determined to make the most sense. If you had an 83-year-old widow on a fixed income, chances are the advisor wouldn't recommend an emerging markets fund. Same idea, the type of product that's most appropriate for a given client is a function of their risk tolerance, the asset allocation that goes with that corresponds to that risk tolerance, the time horizon over which we're going to expect performance, and what is that expected performance. And so I think I mentioned at the beginning, there's two takeaways that I would encourage everybody to write down. The first one was COI plus E minus I, as a reminder to get those and examine those three pieces of information in the detailed expense pages. And the second one is RATE. Whenever you're being presented with an illustration, you want to make sure that the rate reflected in the illustration is consistent with the client's risk tolerances for risk tolerances, is consistent with the historical performance for the asset asset classes underlying the asset, is consistent with the time horizon and the risk that may be exacerbated over a shorter time horizon, and what are the expected outcomes, both from in terms of historical performance, but also in terms of what's the client expect, so that you kind of bring those two things together and make sure that clients' expectations are not disappointed again the way they've been disappointed in the past. And if you download the slide, I'm not going to go through this, but if you download the slides, I've got kind of a cheat sheet. It's not scientific. It's just back of the napkin thumbnail sketch that if you have a client who's in a particular risk profile, and this is not to say it's always true, universally true, but there is a product that I think corresponds with each risk profile, and there's a rate of return that's reasonable to expect. And I promise you will see illustrations that show rates of return that are actually higher than the ones that are on this chart. That doesn't mean that the insurance company can't get them, but I think as a matter of exercising reasonable care, skill, and caution, it's the advisor's job to ask questions. Okay, so you're showing an illustration that's got performance that's 200 basis points higher than the historical rate of return for the asset classes into which you're required to invest. How are you going to do that? That's the type of thing that I think this RATE acronym helps us remember and promote. So we've defined roles, responsibilities, conflicts. We've defined goals and objectives in a way that more naturally lead to prudent product selection. We've got an acronym for prudent for identifying the prudent product type, and now we're going to formalize the selection of the actual product, and need to understand, for reasons we'll talk about in the next slide, need to understand that the best available rates and terms is not a function of a particular compensation model. It's not a function of a particular distribution channel. It's not a function of proprietary versus non-proprietary products. So these constraints, so if the advisor you're working with is constrained by any of these constraints, if they're constrained by a compensation model, if they're constrained by a distribution channel, or if they have a predisposition for proprietary or can only sell proprietary products, your chances of getting best available rates and terms are, your chances of your client actually getting best available rates and terms is less than if you were not constrained by these limitations. So if we were to search for best available rates and terms, understanding these constraints, and do it the way most every other asset is acquired every other asset on the client's balance sheet is acquired, we would come up with a search criteria. And so the 5 things that we think are important every time, there may be more than 5 things in some instances, but the 5 things that are important almost every time when looking for best available rates and terms in life insurance is the financial strength and claims paying ability of the carrier. Life insurance is a promise to pay. How good is the promise? Financial strength and claims paying ability is not perfect, but it's an indication of the how good the promise to pay is, an indication of the risk associated with the promise to pay or not. We measure the cost, the competitiveness of internal policy charges, which, as we alluded to before, can be significantly different from the premium because of the games that are played in some of these illustrations. We measure the stability of pricing representations. Are costs, or is performance, is the illustration, John talks a lot about the reliability of the illustration, is the illustration based on the carrier's actual mortality experience, or does it include mortality improvements? Is it based on the insurer's actual operating experience, or does it include operating gains? Is it based on actual historical investment performance? Not that past performance is a guarantee of future results, but it's one way to set expectations. Is it based on actual historical performance or something else? So we measure those things in pricing stability. We measure the liquidity of the client's access to policy account values. All other things being equal, if the product was identical in every respect and one policy had access to cash value and one policy didn't have access to cash value or had some restrictions on the account, I would take the one anyway that didn't have the restrictions. And then lastly, and most inexplicable to me, is when I was back in the pension investment advisory business, everyone would ask, what's past performance of this fund? What's the track record? And it is inexplicable to me that the insurance industry presents these hypothetical projections based on some assumed rate of return, and too few advisors and clients ask, what's the actual historical performance been? It's the question that's asked for every other asset on the client's balance sheet. It needs to be asked more often when it comes to life insurance, and that's the 5th out of the 5 things that we report on. The 5 in the Veralytic system, each metric, each factor of competitiveness is awarded a star. So if you got a product that's competitive overall, they're going to get 5 stars. If it's a product a life insurance product that is not as competitive in one area, then the area might get half a star. And if you got 2 half stars, then it's only going to be a 4-star product. And this is different from something like a Morningstar, where Morningstar measures one thing. So a 5-star product is always better than a 4-star product. We're measuring 5 things. So it's important to match up each of the stars with client preferences. For instance, if a client says, look, I've always heard that no life insurance death benefit has ever not been paid because the insurance industry came to the rescue of a failing insurer. So why do I want to pay more for financial strength and claims paying ability? So if the client doesn't care about financial strength, then a 4-star product may be most appropriate in their situation. So that's just a difference that's worth noting. But the greatest unknown in the life insurance business is cost competitiveness. I've already alluded to the fact that there is an 80% swing between good and bad pricing. So not only is it unknown, but it can be harmful to clients. If you don't know what's being charged, you don't know if you're being overcharged. And if you don't know if you're being overcharged, you may be overcharged almost twice as much as what the client should be charged. But with Veralytic, in the time that it takes, in less time than what it's going to take me to explain this chart, you can eyeball whether or not your client's being overcharged or not. Again, because with the database, we know there's an 80% variance between good and bad pricing. That means that if you know where the mean is, if you know where the mean is, then you know where worst available rates and terms are, and you know where best available rates and terms are. And so with a glance at a Veralytic report, in this case, you can see the costs of the policy under evaluation, whether it be an in-force policy or a new business proposal or a recommended product. You can see that the bar on the far left-hand side, those costs are 40% less than the middle bar, which is the benchmark averages for all comparable policies. And if you're at 40%, if you're at or near 40% lower than the benchmarks, then you're in the realm of best available rates and terms. On the other hand, if the bar on the far left, did I say that wrong before, John? The bar on the far left is the product under evaluation. If the bar on the far left were up above that black line, then you'd have a client who is getting significantly overcharged. And in the same way that my dad built an RIA, a good-sized RIA, and others have built much more significant RIAs, doing nothing more than offering a review of assets, looking at the costs, finding cost savings, and then giving the cost savings back to the client. I call it the flashlight, ruler, and bag of money business development strategy. All you need is, you got to get the detailed expense pages, as we've talked about on numerous occasions. That's the flashlight. You got to get the detailed expense pages. Get the flashlight out. Once you get the detailed expense pages, get the ruler out. That's Veralytic. Once you get the ruler out, you measure whether or not the client's being overcharged or not. If they're being overcharged, then you get the bag of money out and you put the potential cost savings into the bag, and you tell the client, look, if you're willing to qualify for lower costs, then I can give you this bag of money, and you can spend it any way you want. I can give it back to you in cash. You can buy more death benefit with it. You can lower your premium with it. You can reduce the risk of a premium call with it. What you do with it is your job. My job is to go find the bag of money. And so that's again, in the same way that I think a good many RIAs, big RIAs, were built on that same type of fiduciary focus on asset management. The life insurance business is primed for that, and it is in desperate need of management.
Yeah. Hey, Barry, there's a couple of questions here, somewhat related. One question relates to commissions, and I just want everyone to know that a couple of years ago I sent out an email to all advisors, outlining to them, what we make with term and permanent and disability income and long-term care. So I have no problem sharing that information with anybody that wants it. I think what happens, Barry, maybe the spirit of that question is that I think there's a perception that commissions are the largest load, perhaps in the premium of a typical policy, and I don't know, in the long run. I think you've analyzed it and come up with a different response to that. I think, right?
Well, it depends. So let's first go with the kind of conventional wisdom that commissions are the largest expense. In Mr. Cochran's case, where he bought a policy, and then less than 10 years later he was sold a policy. He was sold a policy. Less than 10 years later he was sold another policy. Less than 10 years later he was sold another policy. In that situation, commissions probably were the largest expense. So I don't mean to minimize the importance of considering commissions, but in a prudent process where you're defining goals and objectives up front, you're using RATE to identify the right product type. You're doing a search for a product that has competitive cost, competitive performance, and stable pricing representations. Then you've got a client who's got an asset that they're more likely to hold it over time. And if you hold it over time, and thank you for coming back to this, because this is something I wanted to mention and I forgot. If you look at the bar chart, is the arrow showing up on your end, John?
Yes.
Okay. So if you look at the bar chart, cost of insurance charges are shown in blue. So here, this is the present value of all cost of insurance charges over the holding period. The maroon are the policy expenses that the insurance company charges, and the yellow are the premium loads. The insurance company collects premium loads, and then they can use some of these expenses to pay commissions. So commissions come mostly, not absolutely, but mostly, overwhelmingly from these two sources here. The insurance company collects cost of insurance charges predominantly to pay death claims. They collect cost of insurance charges from the living to pay the death claims of the people who were in that same pool, people who passed. As you can see here, cost of insurance charges for a prudently selected product that's properly managed, cost of insurance charges are 85% of the cost equation. That's why I said I'd come back to this, and I almost forgot. So, John, thanks again. But so if you only look at no load products, and there's two or three of them, two or three insurers. If you only look at no load products, and their products don't happen to have competitive COIs in that cell, and there are 10,000 different prices for every single product. So I'm not saying that no load products have inherently higher COIs or lower COIs. There are 10,000 different pricing combinations and permutations for every single product. Different price for every age, different times 2 for gender, times 3 to 5 for health risk class, times 4 to 5 for volume breakpoints, times however many for the different commission discounts that an advisor may or may not give, times another 2 or 3 for smoke, never smoke, non-smoke, and never smoke. I mean, you do all the math on that, and there are at least 10,000 different prices for every single product, and where those differences all show up is in the cost of insurance charges. So if you're constrained by your compensation model, and you're limited to only no load products, and the 2 or 3 products that you have available to you because of that have high COIs for that particular client circumstance, then I would argue you'd be better off with a commission product, particularly a commission product that allows for discounts of 90 or 95%. So you can get you can get to low load, almost to no load on a commission on many, not all, but on many commission products. And if you get if you find the low COIs, COIs have an 80% difference between good and bad pricing. Commissions are max 15%. So if you've got the wrong COIs and you give away 15%, you're better off with the right COIs getting an 80% savings, even if you pay a little bit of commission. That makes sense?
Yeah. And then, there's another question. It says, life insurance products offer various guarantees that do not apply to mutual funds, and some guarantees are stronger than others. Doesn't the presence of these guarantees make the analysis different?
Yeah, absolutely. A guarantee is a qualitative factor. Cost is a quantitative factor. And I think that falls in a similar category as some clients care about the financial strength and claims paying ability. Some clients who are risk averse want guarantees. I've seen situations where a product was allocated 100% to a conservative asset allocation, so like a universal life product where assets underlying cash values are required by regulation to be allocated predominantly to high-grade bonds and government-backed mortgages. So it's a conservative asset allocation. The carrier had a track record of never increasing costs and had a track record of superior performance relative to their peer group. And so there's some risk of a premium call there, but not much. But some clients still say, look, I just want the guarantee. But it's a qualitative issue. And so there's a difference in cost between guarantees have a cost. There's a difference in cost. So what's the cost of the guarantee? And then does the client want to pay for the guarantee? And if they do, I am not saying that guarantees are not part of the equation. They are absolutely positively part of the equation, and it is absolutely positively different than mutual funds, and it's part of what needs to be talked through. Yes, good question.
Okay. Hey, I'm going to, Barry, I want to finish up here, and I think most people will want to stay on for a few more minutes, but for those that have to cut out right now because they have a commitment on top of the hour, the second password is research. For those of you that have to leave, but we're not done yet, right? So go ahead, Barry.
We're close. I mentioned a couple of things in the course of my remarks. We've set up a web page, which I'll get to in a minute, where you can download a copy of the best practices. It is a framework. It's only 8 pages long, so this is not like everything you wanted to know about the prudent selection or retention of the right product and the management of life insurance. It's a framework. I think it's very useful and should be available. It is available on a web page that we'll come to in a minute. I mentioned before the Cochrane case that I wrote about. I think that is a really, really good outline for the differences between why life insurance has underperformed clients' expectations and had the fiduciary actually performed the required fiduciary duties, specific fiduciary duties, how the results would have been so much better. As an example of what to look out for in the unscrupulous life insurance pricing or industry practices, and what you can instead do to add value to the client and make the performance of this asset better. The Goldman Sachs case, just because it's interesting reading. There's a marketing piece that you can use, and if you're a subscriber, you can co-brand for the 3 questions that everybody should ask whenever doing a policy review. There are a good many brokerage general agencies and insurance marketing organizations and producer groups who offer policy reviews. But if you're actually advising clients, if you're a RIA or you're an advisor under the 1940 Act, or you're a CPA or an attorney or a trust officer, you got to ask these three questions before you take on one of their policy reviews. And then lastly, we talked a lot about Veralytic and how it supports the best practices in more ways than we were able to talk about today, but it supports these best practices. I'm happy to provide a complimentary Veralytic report to anybody who's on the call. Every report includes an executive summary that summarizes why the rating is what it is. It includes the graphic analysis. As you can see, there's much more to it than just the policy expense breakdown. And you can download all of that at the link that you see on your screen right there, although I don't know that the link is live, so you're going to have to write it down. But it's www.veralytic.com/Ryan Insurance today's dates in 2 digits for the month, 2 digits for the day, and then the 4 digits for the year. And it is important. I tried to make this not a requirement, but it's important to put the .aspx on at the end of it. If you don't put that up there, you're going to get an error.
All right, looks good.
So I'm happy to hang around for any additional questions, but I think we came in almost under the wire, John.
Well, for those that still didn't get it, the second password is research. And thank you so much, Barry. As you can tell, this is really a 2-hour presentation. We had to get Barry about 7 cups of coffee just before the presentation, make sure he could get through it. But any other follow-up questions, here's how you can reach me or Barry. And just want to thank everybody for attending. And if you have questions about how Ryan Insurance Strategy Consultants works with fee-only advisors and the evaluation of clients' insurances, let me know. We have access to the Veralytic reports. Those of you that, or Barry, he's the inventor. You've got questions, feel free to go right to Barry as well. So I think thanks to everybody, and be on the lookout for an email from us with information on how to get the recordings and the slides, and also the information that we need to file for your 1 hour of CFP CE. So thank you very much for all of you, and if you have any other follow-up questions, just let me know. Thanks. And
by the way,
Barry.
John,
yeah.
By the way, somebody wrote, OMG, I could not write that fast. Put the address up again. So we'll include the address. We'll include the download address in the email, and then here's how you get a hold of everybody. So I thought that was funny.
Okay, all right. I thought they were going to say, "Oh my God, that guy talks fast." But anyway, anyways, thanks everybody, and thanks Barry.
Thanks, John. See you.
Yeah, bye-bye.
Bye.